For the first time since May 2020, the Monetary Policy Committee unanimously decided on Wednesday to revise its policy repo rate in a surprise off-cycle meeting. The RBI had last hiked the repo rate by 25 points in August 2018. Reacting to the announcement, Sensex tanked by over 1,300 points on Wednesday. So what exactly is repo rate? Commercial banks like SBI, HDFC, ICICI tend to borrow money from the RBI in order to overcome the shortage of funds. RBI charges an interest rate against this borrowing, which is called the repo rate.
The MPC decided to increase the policy repo rate by 40 basis points, and it also decided to remain accommodative while focusing on withdrawal of accommodation to ensure that inflation remains within target going forward while supporting growth.
This repo rate has been increased by 40 basis points from 4% to 4.4% as announced by the RBI Governor Shaktikanta Das. In case of rising inflation, the repo rate is usually hiked. A hike in repo rate will directly impact the demand for loans as most of the retail loans are linked to repo rate. It discourages borrowers from taking loans, impacting demand for homes and automobiles. Less public borrowings lead to fall in money circulation in the economy, eventually controlling the inflation. While on the other hand, reserve repo rate remains unchanged. It is the interest rate given by the RBI to commercial banks for parking their excess funds with the central bank. It is like you and me depositing our money to get an interest rate on it. RBI has also increased the CRR or the cash reserve ratio. In simple terms, it is the minimum cash reserve that the commercial banks mandatorily need to deposit with the RBI. CRR has also been increased to 4.5% by 50 basis points. Banks do not earn any interest rate from CRR. When the CRR increases, banks have less funds to lend and therefore the money supply in the economy is reduced, controlling the inflation. This is Amogh Rohmetra for ThePrint.